Well, hello and a very warm welcome to this webinar, Asset Quality Review of European Banks, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator for today. And I'm delighted to be joined by Nicolas Hardy, Scope's Deputy Head of Financial Institutions.
Good afternoon, Keith. Good afternoon, everyone.
Now, as we will have seen, higher rates have benefited European bank profitability owing to wider net interest margins. But at the same time, the economic and geopolitical backdrop, as well as the general business environment, have been and continue to be challenging. So how has asset quality held up through 2023, and how are the banks positioned to withstand any deterioration? In a moment, Nicolas will take you through a presentation designed to answer those questions. Now, after the presentation, we'll be happy to take your questions. So please do type these into the questions tab as we go along. And one more thing before I hand over to Nicolas, Scope will be publishing a research note on this topic around mid-November. So we'll let you know when that's out. So that's it from me. Nicolas, great to see you as always. Let me hand over to you.
Thanks a lot, Keith. So today we discuss the big picture, how asset quality metrics are evolving for European banks. And we've opted for this title, European Banks at a Crossroads, and we'll elaborate on this title. So where are we at the moment? I think it's nice to step back a bit and look at the long-term trend, because across Europe, since the last financial crisis, we have had a very interesting development in terms of asset quality for European banks. Basically, we've had a huge cleaning of balance sheets. And you can see that on the left hand side of the slide, this evolution from 2015, and to date. By 2015, we were at sort of the peak of the stock of non-performing loan in Europe, close to 1 trillion at that time. And it took about 7 to 8 years to reach that peak. So it's very important also to keep that in mind when we discuss challenging operating condition and NPL formation. There is always a time lag, and the peak was reached around 2015. So we were there, and in a couple of years, 7, 8 years, we've reached about 40% of this total amount in 2015, 1 trillion. In June 2023, we were at about 400 billion. So that was a very active balance sheet cleaning. Lot of efforts put into that. Efforts also to create the infrastructure to clean banks' balance sheet across Europe. Now, if we zoom in and we base a bit this evolution, we start at the end of 2019. That's the chart in the middle. And this was just before the start of the pandemic. And we were all expecting asset quality to deteriorate very rapidly given the macroeconomic shock at that time, early 2020. And it did not happen at all. You can see the trend. Balance sheet continues to improve over time during that period. And that was a very positive development. So what we were fearing a bit because of the support measure was that we could see a sort of lag effect and a catch-up effect in terms of NPL formation. And then came this change in monetary policy with the decisions to increase interest rates. So we are now in this last rebasement. We look at early 2022 when the ECB started to revise interest rate upward. And since then, so about 12 to 18 months since this move started, we don't see yet asset quality deteriorating, but we are at really an inflection point. So this is why we believe European banks are at a crossroads, is that for the first time, based on the June 2023 EBA dashboard, we can see that the stock of NPLs is growing again. And this is a very new trend compared to what we have seen over the years in the past. Here we are looking at the stock of NPL. Of course, it's important to compare that also relative to the size of loan books also. And so at the moment, as of June, we were at 1.8% NPL ratio, weighted average across Europe. And also just to compare, by mid-2015, we were at around 6%. So it was divided by more than 3 over time. 1.8% NPL ratio as of June 2023. So it's a very solid starting point as we enter more challenging operating conditions. And this is what we are going to look at in the coming slides also. So first headline metrics, non-performing loans. If we dig a bit into the details of this evolution over time, we know that a few countries that were weaker in terms of asset quality metrics than others have made huge efforts and have largely contributed to the current situation. So we can think, you can see that on the right, and on the right we only focus on the very recent years, but you have the long-term view on the left. Greece, Portugal, Ireland, Spain also at the beginning of this period, they made a huge contribution cleaning their balance sheet so that we are now at this very low level. So it confirms also this convergence that it's not only countries that were not heavily impacted by asset quality deterioration that made progress. It was really a convergence. And this is really a theme across this presentation, that the very solid starting point at the moment, I think it's a very positive development for banks to see that across Europe we are observing this convergence between markets. When we look at individual banks also where we are, and here we are looking at the largest European banks, and we've added some UK banks also. What we see is that since 2021, there is again this convergence in terms of NPL ratios across the board. Convergence, you can look at the scale also. We are from 0 to 5 only, meaning that in many countries, we've came lower this 5% threshold, which was a sort of threshold to measure improvement of asset quality across the board. So that's again another testimony to this long-term evolution of NPL improvement across Europe. Now we move to a second very important headline metric. So we have seen NPLs improving. In terms of impact on P&L, the cost of risk, how it has evolved over time also. And here we'll focus more on the pandemic era and since then. If you remember, in 2020, many banks have made efforts to provision in case of a surge of NPLs. And it was mainly made at the very beginning via stage 2 loans and management overlays. So really the decision to allocate provision in case of a deterioration of asset quality. Finally, it did not happen. And the good thing is that we have a flat line on the left. And it means that many banks have kept the buffers they have made during that time very challenging. They haven't reversed the provision or entirely the provision made at that time. And what we've seen in recent quarters, and it's still the case, is that banks are moving the provisions that were allocated to the pandemic situation to other more vulnerable sectors. And the reason why we have had this situation also is that right after COVID, we've had some geopolitical risk in Europe, and banks were cautious about the potential impact on macroeconomic performance, also energy crisis or energy prices moving up. So banks decided to keep the buffers aside. This is a very positive sign to have those extra buffer that relates to performing loans at the moment, in case in the future we observe a deterioration of asset quality. And we have seen also the convergence of the cost of risk on the right. You can see this by country, and it's the same evolution again, looking at banks. For the first half of this year, so now we look at the very recent past, you can see that for many banks, the performance in terms of cost of risk was better than even 2022. And some banks had a reversal of provision during the first half of the year. What we observe at the moment is that banks are expecting a cost of risk to be closer to the medium term average at the moment. So there is an ongoing normalization, but after a very good asset quality period. So again, a very solid starting point looking at those metrics at individual banks. Now, if we move from the headline metrics we monitor to potential early warning signal that asset quality could deteriorate if indeed we are at a crossroad. And the first important one, of course, here it's really big picture, of course. We are looking at real GDP for the largest European countries. And we look at the IMF forecast that were published just a few weeks ago as part of the World Economic Outlook in October. What is very positive here is that, yes, indeed, we have a few countries that are facing some difficult economic conditions in 2023 that are in recession. But looking at the prospect ahead, and we are already in November 2023, so we are supposed to have good visibility on 2024, we can see that the macroeconomic prospects are relatively sound. This is, again, look at the scale. It's moving from 0 to a max of about 3%. So it's not really bright, but at least we do not see, as a baseline scenario, Europe entering into a recession. So that's the key message on that slide. If this baseline scenario proves to be correct, there is not a massive NPL shock to be expected just because of macroeconomic performance. A second interesting potential early warning signal relates to lending dynamics. At what speed credit is provided to the economy, how banks are managing underwriting criteria, and what is really the credit demand from borrowers. So we have, again, here this starting point pre-COVID. We can see that during COVID in many countries, credit supply worked well. And now we've reached this inflection point. It's not really a surprise because that's what we should expect in the context of rising interest rate. And this is a sort of natural transmission mechanism between rising rates and the attempt to slow down the economy to fight inflation at the moment. So that's really an illustration of how the ECB monetary policy, and also how this is done by other central banks, how it's gradually taking effect on the economy. What is very positive here is that what we observe at the moment, it's a slowdown of macroeconomic performance and a slowdown of loan production. And this is controlled, and banks are managing also this trend by having tighter underwriting criteria. So it's not something that is out of control. It's a deliberate movement at the moment. The key question, of course, is for how long, and is it going to accelerate this slowdown in credit production? So those are questions for the future. A third interesting early warning signal for us is relates to the stage 2 loans. So if you remember, under IFRS 9, this accounting rule, customer loans may be, and others may be classified into 3 categories. Stage 1 and stage 2 refers to performing loans, and stage 3 refers to non-performing loans. The stage 2 loans are the ones that are showing sign of potentially credit pressure, and they are classified as such, a sort of watch list for banks. And where are we at the moment in terms of stage 2 loans? We can see that after also the pandemic, where many banks have increased, and you can see that on the left hand side, many banks have increased the portion of loans under watch, stage 2 classification. It's coming down in recent time also, meaning that banks have confidence in those pockets, potential pockets of risk. And also on the right, confirming this trend, we can see that the coverage by provision of stage 2 loans is not increasing, meaning that, again, banks are confident that those stage 2 loans are unlikely to trigger massive problems going forward. So here we are just looking at the past, so we need to be very cautious, but we have all those signals showing that at the moment, asset quality are well under control. This is again a confirmation of the trend regarding stage 2 loans looking at banks. Convergence, the breakdown among banks show how homogeneous this is. Of course, you have some banks that are making some efforts, but you can see also that since the end of 2021, there is no major surprise, there is no major downside risk emerging there. We can see a slight increase here and there, but nothing massive, even for the banks that have the largest portion of stage 2 loans ratio. So this is where we are. I'll hand over to you, Keith, and come back to this, I think, very interesting evolution across Europe.
Excellent. Nicolas, thank you very much for that. Some fantastic slides there, and thanks for taking us through them. And so please do type your questions in as we near the end of our session today. But Nicolas, I've got some questions here. So if you don't mind, I'll launch right into them. So you pointed to data to June 2023, and I was wondering if you can give us a bit of an update. So we're in the midst of Q3 results. From what you've seen, have there been any material changes so far?
Yes, so yes, we are just in the middle of this Q3 earnings season, and most of the materials here are based on June 2023. So it's really, we are monitoring bank after bank what comes out of the Q3 results, and I would say there is no big surprise. There is a continuation of the trend. We cannot deny that banks are facing an increase of the cost of risk. Some display an increase also of their stage 3 loans, but it's marginal and it's very gradual. So I would say it's in line with our expectation that asset quality is very likely to continue to deteriorate moderately quarter after quarter. And at the moment, so per se, it's not a positive development, but the way it's controlled and how solid the starting point is, it's not an element that is at that stage putting pressure on the banks we rate. So we are not changing at the moment outlooks we have on banks rating because of asset quality pressure.
Okay, excellent, thanks. I guess a similar kind of question, which is, given the solid starting point, albeit as you explained very clearly, there's been some deterioration, how do you see the future? And perhaps an added nuance to that question, from where you look today, might there be greater challenges in those previously very high NPL countries that you mentioned in your presentation?
Yeah. So I think we are all looking at that from for quite a long time now, at least since the start of the COVID crisis. We were expecting asset quality to deteriorate. It did not happen. And now with the rising rates, this is also something that we are monitoring very carefully. I think we have no option but to go through scenarios to understand how things could evolve over time. So let's imagine three different scenarios. The first one would be about upside. How likely upside is at the moment. Upside, I mean a very stable evolution of asset quality, rosy macroeconomic condition, etc. That would be the upside. To me, there is very little potential in terms of upside at the moment, because we are just in the middle of this fight against inflation, and rising rates, it's hurting. So the uncertainty is about how long it's going to last. But at the moment, I see little upside. The baseline is what we observe at the moment. So this inflection point from a very solid starting point. And it's a bit difficult to say that we are going to see a reversal, but that would be the third scenario. Let's think of a reversal of the trend and an acceleration of the trend. And how could that evolve? I think we need to look back a bit at history and just imagine if a scenario where we would see just a repeat of the past, a reversal is something we could think of. I think at the moment, there are countries that we've seen very rapid improvement. So a bit of volatility that was positive to be able in a short period of time to improve asset quality. It's potentially the countries where we need to have this confirmation that things could not repeat. And it would be really too simplistic to expect that the chart on the left, we could have a symmetrical repeat of what we have seen in the past. So it's very difficult to imagine that the vulnerabilities that were the root cause of the problems that we have seen and that were addressed since 2015, and I would say thanks to the work done at EU level to solve those issues, it's very unlikely that we see a repeat. I think the world has changed since 2015. Monitoring of banks have changed. We are here only focusing on asset quality, but look at capitalization, improving profitability for banks in the context of rising rates. Those are also very comforting elements to expect. Yes, some downside, but a controlled downside in the short term. I mean, in the coming, at least the coming 2 quarters, I think we have good visibility, unless the unexpected, of course. Keith, I think you are on mute.
Yep, thank you for that. There's a question coming from one of our viewers, Nicolas, which refers to something you were talking about about stage 2 loans, which is how do you explain the decreasing or at best stable stage 2 corporate portfolio in the light of the challenging economic situation? Yeah. And there's a slight technical one, which what's the portion of UTP in stage 3? I'm not sure if you have that data to hand, but certainly, can you perhaps talk about stage 2 evolution?
Yeah, no, so interesting question. I won't enter into the details of the bank's provisioning policies and what you have that is sort of core stage 2 provision, what is management overlays, and sometimes they are aggregated. In some countries, it's called precautionary provision. It's unallocated. And in other countries, this is a bit more challenge, the fungibility of the stage 2. I think what's very interesting with the stage 2 loans, it can refer to two different things. It could be related to sectors that are really entering into more difficult times, and banks recognize that and classify entire sectors as stage 2 loans, because things are getting a bit more complicated for the companies that are operating in those sectors. But you also have banks that are very conservative and classify entire sectors, also portfolios, as stage 2, because they anticipate that it may becomes more problematic, even if it's not yet the case. So stage 2, to me, it's quite judgmental, largely judgmental. And what we've seen recently is that banks were able to transfer from one root cause to another the layers that they have accumulated over time. So the reason why it's not moving at the moment, stage 2 loans, I think we are here looking at overlays. We are looking at extra provision. It's true that a recent evolution that we've noticed in terms of IFRS 9 provisioning policies by banks, in recent times, what we observe is that banks are allocating more provisions to stage 3 loans and less to stage 1, stage 2. It means that there is less of extra layers. Now we are really provisioning for problem loans per se. So it shows that we are also maybe entering more difficult operating conditions.
Yeah. Okay, actually, Nicolas, there's a similar, it was a related question to stage 2 that again is quite specific, but again it's about the stage 2 loan ratio not deteriorating, but the question is, and you may have to get back to our viewer with this one if you don't have the data to hand, do you know the transfer ratio from stage 2 to stage 3 and the increase in volume of that transition? And that's quite specific.
Some banks provide that also, and it's more at interim, full year and interim data that we have this. I think we have bank by bank the data. We haven't aggregated, and it's not just by looking at the evolution of stage 2 and stage 3 loans. At the moment, what we see, banks usually, when they comment on the increase of stage 3 loans, they refer to specific files that were not automatically part of stage 2 loans until recently, or at all even. So you could jump directly from S1 to S3 without being classified as S2 loans. So it's quite difficult to monitor. It's not difficult to monitor because we have bank by bank information on the flows between S1, S2, and S3. But I don't think that's the main reason of the increase recently of the S3 or what we expect going forward. Because we are here handling more idiosyncratic or specific files, problem files, than really sector entering into problems.
Okay, now, which is a great segue to the next question, Nicolas. Talking of sectors that are experiencing problems. Now, exposure to commercial real estate has been potentially, or perhaps the big talking point of 2023. Where are we on banks' exposure?
Yeah, indeed, lot of attention on commercial real estate, and I would say not only on commercial real estate, but also how property markets are evolving, because in terms of mortgage lending also it would have a big implication for banks. So we are looking at the two aspects, commercial and residential. Just commercial real estate, it has been a topic for quite a while already. To me, it's not a no risk, it's a non. It's very well known that banks are, in the context of rising rates, may expect some asset quality issues there. When we look at what's happening, I think we have got a lot of noise around commercial real estate from foreign markets abroad, in the US, in China. They made the news in the recent past because of commercial real estate issues. It's much less the case across Europe. I think it was also a big risk, a big issue during the last financial crisis. And I would say lessons learned, this is under monitoring. I would like to refer to the excellent EBA dashboard, where we've seen also a specific focus on commercial real estate, on real estate activities and construction, with a very interesting monitoring of asset quality there. We have the size of the sector, it's relatively moderate. It's thanks to the diversification of the loan books across Europe. There is a degree of dilution within loan books. And asset quality metrics at the moment, out of my mind, I think for real estate activities, it's 1.8%. And for construction, was it 3.6%? Well below 5% for the two sectors. So yes, it's an area where we see pressure. There is issues in terms of refinancing of commercial real estate in a completely different interest rate environment. It's a pocket of risk, like SMEs that are more vulnerable to changing economic conditions. But at the moment, this is, I would say, a controlled situation.
Okay, understood. Yeah, thank you. There is a question that's come in which is quite specific, which I'll perhaps ask you to take offline, about cost of risk, weight of risk, and net results. But I think that one is quite specific, so I won't put that to you specifically. But to the question, that we will come back to you on that one. So broadly speaking, you laid out a pretty benign picture. Your title, banking at a crossroads, or banks at a crossroads, clearly indicates a slightly cautious view. But what do you see as the main risk for European bank asset quality going forward?
Yeah, so I think at the moment, if we look at the wide array of risks that have been discussed in the recent past, and again, where the root cause of what we have seen. So commercial real estate is one of them. We've had the sector that were heavily exposed to COVID. Are we going to see a lag effect, etc., that could materialize and create asset quality problems? At the moment, I think all those specific risks are monitored. Yes, it's a source of risk, but they are known. The main risk I see for European banks at the moment, and what we've discussing across Europe with colleagues, is really the impact of rising rates. This is the main risk for borrowers in countries where we have variable rates that have changed very rapidly and that have completely changed cash flow patterns for corporates and for households that have to repay their loans. I think this is really the main risk we see going forward. In the coming quarters, the pressure on margin for corporates, on disposable income for retail borrowers, in the context also of inflation remaining for a while. This is really what we need to monitor, the most fragile populations to the rapidly rising rates. And it's good to see that, as we understand so far, there may be a pause in terms of interest rate moves for some time, so that banks can digest a bit this evolution. Yeah. This is also happening at a time where profitability again for banks has improved. So I think it's very important also to see the net evolution. Rising rates are putting pressure on the most vulnerable borrowers, but the capacity of the banks also to face this situation it has improved a lot also in recent times. So that's a positive development also.
Absolutely. Thank you. So there's a question here just come in about a piece of research that our structured finance colleagues published early this year about a third of loans in European CMBS are facing refinancing risk. And so again, unless you have something specific to add, Nicolas, what I will do is ask our structured finance colleagues to actually respond specifically to that question, because they are tracking CMBS underlyings on a day-to-day basis. So unless you have anything specific to add about CMBS refinancing risk, I suspect that's a bit specific at this point.
No, nothing to add on this one.
Right. Okay, perfect. All right. Well, look, there are no more questions here, Nicolas. So I suggest we call a halt to our session. So I'd like to thank you very much indeed for fielding questions and for your great presentation. Thanks also to our viewers for watching. Hope you found that useful. Nicolas' presentation is actually downloadable today. So if you click on apps at the bottom of the screen and then click on handouts, you can see the asset quality review presentation is there. Click on that and click download, and it will be there with you in a few seconds. Just a reminder that we will be publishing also a research note on asset quality. It's clearly very closely related to this, with a bit more some specifics on countries, etc. So when that comes out, we will take the liberty of alerting you to that, so you can take a read of that. This is clearly an ongoing topic. It's a long-running topic, and so to the extent that you know, things do deteriorate or even get better, we will be watching, and as appropriate, we'll come back in the future with another webinar presentation. So let me close there. Thanks again. I wish everybody a successful rest of the afternoon, and we'll see you next time. So it's goodbye from us.
Thank you.